Hello, my friends. I'm Troy White, financial educator and investment portfolio manager at Hoodoo Financial. And today, I just want to have a little fun conversation, identify some of the common money mistakes and common financial pitfalls that I see with clients and just people. And let's just dive into it. So, first common mistake I see or error folks are making is failing to clearly define how much money they need to live their desired lifestyle. Failure to define how much you need to live the way you want. And because if you don't do that, you don't know how much you need to live how you want. So you'll never even identify how you want to live because you are only living according to the amount of money that you are able to acquire right now. So you're going to live $1,000 life when you make $1,000. You live $100 life when you have $100, but you never identified what you really wanted. And so by not doing that, you don't pursue that lifestyle, those life choices. And so basically it's a doing it backwards. You just taking what's coming to you instead of planning for something and pursuing that. All right, next point is lack of a clear financial plan. That is directly related to the first thing, failing to identify how much you need for life. Well, you couldn't identify how much you need because you didn't make plans. Because if you had plans, you would have identified goals, and you would have a method. You would know what it takes, what that goal target is. So you must have financial plans. Financial plans forces you to follow a method to identify your goals. So you fundamentally making plans to achieve your goals. So by financial planning, you are really engaged in life planning. And so the third issue is that you have no trusted financial mentor, advisor, or coach. And the thing there is when I say no the key word is trusted, because people have financial advisors, mentors, and people who could be coaches. Because at your job, you got an HR department, and at your HR department, there's someone assigned to the employees there to service those 401k accounts. And so that person is where you should start. If you don't have no other financial services provider, go there. You can start there. And then who's your tax professional? Go there. And who helped you buy a house? Go there. Where's your bank? Go there. And follow my link. I'll put it in the comments. Go there. You have access. You got to use it. But the key thing I said, trust it. You have to be able to trust them. They have to speak to your needs. You have to trust that have concerns to help your problems versus most financial services industry, um, points of contact for you are genuinely interested in your dollars, and they want to do business with you, but they don't. That's not saying they want to help you solve your problem. They want you as a client, generic client, to come in the door, and so there's a difference there. Also, let's move on. Um, Poor financial choices due to lack of financial knowledge, and then that causes you to act on fear and greed. So those that's a big chunk right there, big chunk. So these are all kind of rooted in the lack of financial literacy and your investor behavior, financial psychology issues. And so that's what's up. Taking advice from the wrong people. Who is the wrong people? The person sitting next to you telling you what they did that helped them. And so oftentimes, they're actually all the time, people only tell you about their successes. They don't tell you about their failures. So, they failed on 10 stocks, but they told you about this one stock they hit on. And, so you get the impression that they are the investment genius that you have access to, but they have more failures than successes. And so, that's not going to help you, and then what's good for that investor is not necessarily what's good for you as an investor, because all investing is personal. Your personal circumstance doesn't match theirs. So what they should have done is different from what you should have done. And moving on, um, problems snowball out of control. And so that is one of the common pitfalls that individuals make, because when you have a financial problem that is not addressed, it snowballs, it compounds on itself, and then leads to other financial issues that again snowball and lead to other issues that snowball. And so you must tackle your financial problems, and we can't put our head in the sand and pretend they're going to go away, because they don't. All right, unrealistic expectations of return on investments. People think, oh yeah, if I put my money in the stock market, I'm gonna be rich, and on limited knowledge and limited dollars invested, and limited time of even investing. And then what happens is you don't see the results that you were expecting, and you see losses, and then you pull the trigger, and you become an official loser, and then you get scared you'll never do that again, right? And so that's because you had unrealistic expectations from the get-go. All right, the other is poor financial habits that developed at an early age. All habits, financial habits, develop starting at a very young age, and it's based on the financial literacy that you receive from your parents, or the lack of financial literacy that you receive from your parents, the financial habits that were modeled by your parents, whether those are good or bad, are imprinted in your financial script that exists in your mind. And so this has been written starting at an early age, and it's hard to reverse that. And the only way to reverse it is through financial literacy and actual investment experience while you're receiving that financial literacy. You have to do it and learn about it at the same time and improve as you go, because we have to reverse knowledge through experience. Reverse those. No diversity of assets. So lack of diversity in your investments fundamentally is a problem. And that's how you lead to bigger problems. You put all your eggs in one basket, and then when that particular industry or that stock or whatever sector you're in, whatever position you're in, when it goes down, you react out of fear again, and you sell it instead of maybe buying more, because if you felt strongly about that position in the first place, then you should be buying more when it goes down on the dip. But people don't. They get fear and they sell it, and so now they're an official loser. And because they didn't have no diversity, that was everything they had. And so that is the biggest mistake, and it stops people from investing in the markets in general. And then I save this one for last, is your emotions. If you cannot control your emotions, you also cannot control your money. If you cannot control your emotions, you cannot control your money. And this is true in investments. It's true with budgeting. It's true with impulse buying. It's true with financial planning. And it's you've got to get your emotions out of it and take a look at what's really going on. Take a look at these numbers and the emotions. I could go on and on and on about the emotions of investing, the emotions of financial planning, how they impact your actions. This is the number one thing you need to fight against. So to battle your emotions requires your knowledge and your wisdom and your financial literacy. It's the only way you're going to be able to battle it, because you're constantly fighting against the demons that's speaking to you. And the demons all got dollar signs, and they're greedy. And the demons in your mind they're greedy, and they're conservative. They don't want to lose a dime. Remember this fact, is that investors hate to lose way more than they love to win. So that's going to drive your investment decisions. So you need to strip those emotions from it and start being a rational person to do rational analysis of your financial planning, your investment strategy, and in your entire financial strategy. for yourself, your family, and your business. All right, I'm gonna cut it there. I talked enough. Thanks for listening. We'll talk some more soon on these topics. It's important, and hope to hear from you soon. Holla.